Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, January 23rd. Yesterday, the S&P 500 hit a fresh intraday high, boosted by strong earnings and Trump's AI push. Meanwhile, the US dollar staged a rebound, crude oil extended its losses, and new measures from the Chinese authorities to revive interest in the Chinese stocks had little impact. Okay, so the US equities were boosted yesterday by strong earnings from the S&P 500 companies and Trump's announcement of massive AI infrastructure investment. So technology stocks in the US led yesterday's rally this time and pushed the Nasdaq 100 1.33% higher during the session. The S&P 500 hit a fresh intraday high, while gains in the Dow Jones Industrial Index were significantly lower than those. The index gained only 0.30% at yesterday's trading session. Now, among the technology names, Netflix jumped. Well, it jumped on the back of strong earnings announced the day before and traded at $999 a share. So that's just short of the $1,000 psychological mark. But I think that is probably just a matter of time before Netflix claims this $1,000 per share level, given that the gains there were driven by the strategic move to include to stream live events on the platform and has room to provide more gains, more growth to the company. Other than that, Nvidia, Oracle, and OpenAI's investor Microsoft, so the names of the companies that are cited in Trump's so-called Stargate project, so that's AI infrastructure project. These companies gained yesterday. Nvidia extended gains by almost 4.5%. Microsoft gained more than 4%, while Oracle jumped up to 10%, but gave back a part of these gains to end the day with an almost 7% jump. And while all this was happening, well, Donald Trump's best buddy, Elon Musk, well, he was probably irritated and very much irritated by the growing closeness between Donald Trump and OpenAI Sam Altman, which is his nemesis. So Elon Musk wrote an X post yesterday saying that these companies don't have the money to invest that much in these AI infrastructure. And when you scroll down actually Musk's profile on X, you see that there is a lot of spitting on Sam Altman. And that obviously comes from the two men's common history at OpenAI, if you didn't know that, because Elon Musk was actually part of OpenAI until 2019, and then he left the company for opinion divergences regarding the risk of OpenAI's two powerful models on existence, for example, and its non-profit company status, and created XAI. Now, funny enough, Elon Musk didn't want OpenAI to be a profit-making company. He didn't the company to pursue profits, but anyway, his ex-post triggered yesterday worries about his relationship with the White House, probably sending Tesla shares 2% lower at yesterday's trading session. So this whole saga in the tech world reminded everyone that the next 4 years will be a lot about following who loves who is friends with who doesn't love who says what, and who's got the power to move things in his or her benefit. I cannot wait. Now, other than the tech news, well, there was actually a piece of good news on the wire from Procter & Gamble's latest quarterly report yesterday, that the company revealed that its organic sales in the fourth quarter exceeded the market expectations, and it's good for them. The company share gained after the report, but what really attracted investors' attention yesterday was that the company's fourth quarter sales growth, well, it actually came from higher volumes sold and not from price hikes, because the company apparently didn't raise the price of its products for the first time since 2019, according to Bloomberg. So that actually gives an interesting and an encouraging insight regarding the US inflation dynamics, saying maybe, but just maybe, they are really cooling. But unfortunately, that doesn't erase the risk of rising inflationary pressures in the US on Donald Trump's pro-growth policies, his tax cut and mass deportation plans, and also obviously the tariff threats and the tariff plans, which are all potential inflation boosters. And indeed, I read in the news this morning that US Republicans are actually in talks over raising the cap for state and local tax deductions. And obviously, tax deductions are bad for public finances. As such, the US 10-year yield is back to 4.60% level after a decline to 4.53% mark earlier this week, while the US futures are slightly in the negative territory at the time I'm talking here this morning. In Europe, while the STOXX 600 index advanced to a fresh record high at yesterday's trading session, on hope that the tariffs that the US would impose on the European economies would be softer than Donald Trump's threats. And so far, the STOXX 600 index gained around 4% since the beginning of January and outperformed the S&P 500, which posted around 3.60% gains since the beginning of this year and of this month. So this is all very much in line with the broad expectation of convergence between the stock markets of the two continents due to this big valuation gap between the two continents stocks, and also on the expectation that the European Central Bank will be more supportive of the European economies than the Fed in the coming months this year. In China, market sentiment is mixed, really. You remember that relief over Donald Trump not announcing new tariffs on China at his inauguration? Well, that relief unfortunately didn't last long, because Donald Trump said yesterday that he would maybe impose 10% tariff on Chinese imports, and that very soon. I mean, this is even more difficult to follow than my 4-year-old's Ninjago stories, right? One day it's red, the other day is blue, so it's all very much confusing, and the news changed very rapidly. So yes, the Chinese equities were down at yesterday's trading session on that 10% tariff threat, and they are having hard time today being happy on the freshly announced measures from the Chinese authorities to boost sentiment. And these measures include an increase to the amount of stocks that pension funds and insurance could buy, and they also include measures encouraging the listed firms to increase their share repurchases. Loss, the CSI 300 index has erased most of its gains today since this morning, and the shooting star formation, the shooting star pattern of today hints that sentiment regarding the CSI 300 index remains bearish despite all the stimulus measure news. In the FX, the US dollar rebounded yesterday on the back of higher US growth and potentially higher US inflation expectations. The euro dollar bounced lower after testing the 50-day moving average to the upside. The European Central Bank does remain in charge of the market, as I said before, and cap the upside potential of the euro against the greenback. Now, one reason that could potentially support a recovery in the euro dollar in the coming days is these crowded long positions in the US dollar. But that said, therefore, the price rallies in the euro dollar look interesting for top sellers still. Across the channel, cable is also under a decent selling pressure this morning, as Rachel Reeves is being seriously challenged and questioned in Davos regarding her budget plans. She actually said that she was absolutely relaxed about wealth creation in the UK and that she'd like to see taxes come down as well. Well, I think she's probably got an excellent mental support to be this relaxed when the world is against her, really. But the truth is, well, investors are not that relaxed and they are losing confidence in her growth boosting budget plans, and the latter will probably continue to weigh on sentiment in sterling, also backed by the expectation of 2 and maybe more interest rate cuts from the Bank of England this year. Finally, crude oil is down for the sixth straight session this morning on the back of Trump's drill baby drill plans, and also on the back of the surprise 1 million barrel build in US inventories last week. So US crude is actually preparing to test a major support area near $75.20, $75.40 per barrel range. That includes the 200-day moving average and the major 38.2% Fibonacci retracement on the December to January rebound in crude oil prices. Now, a move below this zone will suggest a medium-term bearish reversal in crude oil prices and hint at the possibility of a deeper price pullback toward the $73.80 per barrel mark, which is the 50% Fibonacci retracement on the latest rebound. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.